Hi students, in this video we will discuss about classification of ratios. Before that, we should know what is ratio, what is ratio analysis, then we will move to classification of ratios. First, we will see what is ratio. Ratio is the mathematical relationship between two items expressed in the quantitative form. Okay, there are different two types of expressing the relationship. One is qualitative nature, another one is quantitative nature. Here, the relationship is expressed in the quantitative nature, mathematical relationship between two items expressed in quantitative form. Okay, that is ratio. What is ratio analysis? The analysis and interpretation of financial statements with the help of ratios is called ratio analysis. Okay, it is the process. It involves computing, determining, and presenting the relationship of items in the financial statements. Okay, so we should have clear and thorough understanding about what is ratio and what is ratio analysis. Okay, then now we will move to classification of ratios. The classification is based on different bases. Okay, first one is classification of ratios by statements, then classification of ratios by uses, classification of ratios by relative importance, and finally classification of ratios by purpose or function. Okay, there are four classifications based on four different bases. Okay, first we will see classification of ratios by statements. Statements means financial statement. Okay, balance sheet ratios, profit loss account ratios, balance sheet and profit loss account ratios. Some ratios will appear only in balance sheets, some ratios will appear only in profit loss account, some ratios will appear both balance sheet and profit and loss account. We will see one by one. What are the ratios will appear in the balance sheet? First one is liquidity ratio, current ratio, proprietary ratio, debt equity ratio, fixed assets ratio, capital gearing ratio. These are the ratios we can calculate with the help of balance sheet. Once again, liquidity ratio, current ratio, proprietary ratio, debt equity ratio, then fixed assets ratio, capital gearing ratio. These are the termed as balance sheet ratios. Then next one is profit and loss account ratios. What are all the gross profit ratio, net profit ratio, operating profit ratio, operating ratio, then expenses ratio. Okay, these are the ratios will appear in the profit and loss account. Then now we'll see ratios which will appear both balance sheet and profit and loss account. Yeah, first one is return on investment, the next return on shareholders fund, stock turnover, debtors turnover, creditors turnover, fixed assets turnover, earning per share, EPS. These are the ratios. Okay, will appear balance sheet and profit and loss account. Okay, then second classification is classification by uses. Okay, the ratios are classified based on the informations used by the different persons. Okay, for example, ratios for management, ratios for creditors, the ratios for shareholders. What are the ratios used by the management? We'll see one by one. Operating ratio, return on investment ratio, ROI, then stock turnover, debtors turnover, equity, debt equity, fixed assets turnover, creditors turnover, net profit ratio, short-term liquidity, long-term liquidity, working capital turnover, net profit ratio, gross profit ratio. These are the ratios used by management people. Then Second one is ratios for creditors. Okay, current ratio, solvency ratio, debt equity ratio, creditors turnover ratio, fixed assets ratio, assets cover, interest cover. These are the ratios used by creditors. Then what are the ratios used by shareholders? We'll see one by one. ROI, return on investment, return on shareholders fund, payout ratio, capital gearing ratio, dividend cover ratio, dividend yield ratio. These are the ratios used by shareholders. Okay. Then third one, first one is classification of ratios by management. Second one is classification of ratios by users. Third one is classification of ratios by relative importance. First one is primary ratio, secondary performance ratios, secondary credit ratios, then growth ratios. Finally, growth ratios. Under classification of relative importance, there are 4 categories. One is primary ratios. Under that, return on capital employed, assets turnover, and profits ratio. Profits ratio means gross profit ratio and net profit ratio. Then secondary performance ratios include working capital turnover, stock to current assets to fixed assets, stocks to fixed assets, and fixed assets to total assets. These are all come under secondary performance ratio. Then secondary credit ratios include creditors turnover, debtors turnover, liquidity turnover, liquidity ratio, and current ratio. Finally, average collection period and average payment period. Average collection period. Once again, secondary credit ratios include creditors turnover, debtors turnover, liquidity ratio, current ratio, average collection period. Then finally, growth ratios include growth rate in sales, growth rate in net assets. Okay. Then fourth classification is classification of ratios by purpose or functions. Okay. There are 3 functions. First one is profitability ratios. Second one is turnover ratios. Finally, third one is financial ratios or solvency ratios. Under profitability ratios, return on investment, net profit ratio, gross profit ratio, earnings expenses ratio, operating profit ratio, etc. Turnover ratio includes stock turnover, debtors turnover, creditors turnover, working capital turnover, fixed assets turnover. Finally, solvency ratios are further classified in 2 types. One is short-term solvency, second one is long-term solvency. Short-term solvency includes current ratio, liquidity ratio, cash position ratio. Then long-term solvency ratios include proprietary ratio, debt equity ratio, fixed assets ratio, capital gearing ratio. These are the ratios classified in different bases. Okay. Once again, first one is based on statements, second one is based on uses, third one is based on relative importance, finally fourth one is based on purpose or function. Okay. Then, so the ratios are important. Once again, ratio. What is ratio? Ratio is the mathematical relationship between 2 items recorded in the financial statements. Okay. What is the formula for computing different ratios? For example, return on investment. It will be computed with the help of dividing operating profit divided by capital employed into 100. Operating profit divided by capital employed into 100. For example, net profit ratio. What is the formula for net profit ratio? Net profit divided by net sales into 100. Net profit divided by what is net sales? sales minus sales return equal to net sales. What is gross formula for gross profit ratio? Gross profit divided by net sales into 100. What is the ratio for expenses? What is the formula for expenses ratio? Expenses ratio. To calculate the expenses ratio, the specific expenses divided by net sales into 100. Likewise, there are number of formulas are there to calculate the different ratios. For example, turnover, inventory turnover ratio. How do you calculate inventory turnover ratio? Stock turnover or inventory turnover ratio equal to cost of goods sold divided by average inventory or average stock. What is average inventory? Opening stock plus closing stock divided by 2. By using this formula, you will get average inventory. Debtors turnover ratio equal to net credit sales divided by average receivables. Net credit sales equal to total sales minus cash sales equal to net credit sales. What is average receivables? Average receivables includes opening bills receivables plus closing bills receivables, opening debtors plus closing debtors divided by 2. Okay, we'll get average receivables. What is the formula for computing creditors turnover ratio? Net credit purchases divided by average payables. Net credit purchase divided by average payables. What is net credit purchase? How do you calculate the net credit purchase? Net credit purchase will be calculated by deducting the credit sales from deducting the cash sales from net sales. It is the formula for net credit sales. What is the formula for net credit purchase? Total sales, total purchase minus total credit purchase. Total purchase minus total cash purchase. Okay, this is the formula for net credit purchases. Okay, with this we finish. Remaining we'll discuss in the next video. Thank you.